Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to estimated annual tax rate. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have the information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. We're going to be estimating the income taxes for the year. Once we have the income taxes for the year, we'll have the estimated effective annual tax rate. Then we'll take a look at the first quarter tax provision for continuing operations. So when we think about the taxes that we're going to apply for the quarter or interim periods, then we have to annualize things to some extent because, of course, the taxes will change based on the level of income. So we're going to have to figure out, what the annual rate would be and then figure out the taxes for the quarter. Then we'll take a look at a journal entry to record the tax provision. Let's take a look at our information on the left-hand side first. We have the estimated federal and state taxes. We're going to estimate those given to us in the problem, $45,000. Expected annual pre-tax earnings from continuing operations. So we think the pre-tax earnings before obviously applying the tax for the annual earnings is going to be $1,300,000. Expected differences between tax income and financial statement income. So you could think about this. You're going to say, all right, well, if I'm going to figure this out, the first step I got to basically figure out is the expected, annualize the expected income. We got to think about what the total then taxes would be. We're thinking the federal and state, total income taxes. Then we want to think about the differences between the income and for taxes and the income for the financial statements to take that into consideration when we apply the tax effect and the tax calculation. So here we have some information regarding that. There's going to be dividend excluded for dividends received on the company's stock investment. So that's going to be a $90,000 difference between the tax and the books. We have the tax-exempt income of $30,000. We have premiums for life insurance on officers where the company is the beneficiary, which is going to be $14,000. So those are going to be differences that are permanent in that they're going to be differences that will not reverse over time. They're not timing differences that are going to basically just be a factor of when things are going to be included or excluded from income, but whether or not they will be included or excluded. So these will be then having to be removed permanently. Then we have the business tax credit so we have a credit that we want to be taking into consideration because we're going to have to apply that out when we do our estimate for the actual tax liability for the quarter. Then we got the first quarter pre-tax earnings, this is the earnings for the quarter now, $189,000. Then we have the earnings excludes a loss from the discontinued operations before any tax effect. So within this earnings, it includes this loss of the $31,000, which is a loss. Earnings includes a loss from discontinued operations. So a discontinued operation before any tax effect. For the $31,000. Estimated effective combined federal and state tax rate on income from continuing operations for the year. Okay, so now we're going to go through our estimate for that. We'll take a look first at the estimated income taxes for the year. So we want to estimate the income taxes, then we'll go down and we'll think about the estimated effective annual tax rate. Then we'll take a look at the first quarter tax provision for continuing operations now that we have our estimated effective annual tax rate. Okay, so line 1, we're going to be picking up then the income. So we'll take the income from continuing operations. We said on the book side, it's going to be the $1,300,000. This is for a year. This is annualized. We're going to break this down so that we can then get down to the quarter. Then we're going to be adjusting for permanent differences. Permanent differences, including the premium on the life insurance. So the premium on the life insurance, because this is going to be something that is not going to be deductible for taxes. Therefore, we're going to have to add it back in. We said this is basically our beginning number. It includes a deduction of the $14,000 permanent difference. We therefore are going to have to add the $14,000 back in when we think about the tax effect for it. Then we got the dividends exclusion. The dividends exclusion here, and that's going to be income that is included here that should be excluded for taxes. So we got to remove the income. This would be an income line item that we don't have to report for taxes. Therefore, we're going to reduce it. So we're going to subtract out the $90,000 And then we said we had other tax exempt income. So other tax exempt income, if it's tax exempt, means we're not gonna pay tax on. It's not a timing difference. It's gonna be a permanent difference. So we're gonna say, all right, that's gonna be the 30,000 is once again the 30,000 being included in this number on the book side of things for income that's included in that number. It shouldn't be for taxes. Therefore, we will remove the entire thing. I'm gonna put an underline under this. It'll be there on your worksheet already. Then we'll have the adjustment. So these are going to be the adjustments for the permanent differences. I'm just simply going to sum this up equals the sum of the 14,000 minus the 90,000 and 30,000. That's going to be a net decrease of the 106,000. So that then will give us the estimated annual taxable income from continuing operations. I'm going to sum up the outer column, which will obviously subtract the outer column, given one is a positive number and the other is a negative. So I'm going to sum these up, subtracting them out, giving us the 1,194,000. We will multiply that by the combined tax rate. So that's going to be our estimated tax rate over here, which is the 45,000 for income taxes. So we're going to be picking up our 45,000. And then that's going to give us our estimated annual taxes before any credits that we would have. So that's going to give us our estimated taxes for the year. 1,194,000 times this 45 gives us the 537.3. And then we've got the credits that we're going to take into consideration. So these are going to have to be, the bottom afterwards. They're not a deduction. They're going to be a credit. And so we're going to take those out. And the credits were 41,000. So I'm going to subtract those out to give us the estimated income for taxes on the year. So then that's going to give us our estimated income for taxes. I'm going to sum these up, which will subtract them out, which is going to be that 537.3 minus this number that I can't see right now, which is the 41,000. That gives us then the estimated income taxes on the year, 496.3. So you can see we kind of have to project out, the revenue on the year. Then we got to take the differences between taxable income or tax net income and book income. Then we'll apply the rate that we think is going to be applicable given the income tax rate, federal, state income taxes. Then we're going to be having to account for the fact that we could have credits that we'll take into consideration for it when we consider the actual tax effect that we can then break down on basically a quarterly basis. So we're going to take the tax that we have and we're going to divide it by the income, basically the book income, so that we can, when we go to the first quarter, we can multiply basically by the income line item here. So we're going to say, all right, then if I take the estimated effective annual tax rate, it's going to be the 496.3 of taxes divided by the original book income before the timing differences and taking into consideration the credit that came out of here and whatnot. So now, of course, we have a different rate than the estimated federal and state tax rates because, again, this rate is going to be based on the taxable income and it's going to not be taken into consideration any credits. And we need something that that's going to be based on the book income and that's going to be taken into consideration the credits when we do an estimate for the quarterly, when we take it to the quarterly level. All right, so now we're going to say the first quarter tax provision for continuing operations. So now we'll be picking up the total pre-tax earnings, which is going to be for the quarter now. Now we're applying this out to the quarter. The 189,000 for the quarter. And then we had the extraordinary loss that is reported separately with its own income tax effect. So we're going to be taking that into consideration. This 31,000 was a loss, and we're actually going to add this back. So this is going to be the first quarter income from continuing operations. And that's because this 31,000 earnings includes a loss from a discontinued operations before any tax effect. So we're going to add that item back in. So that's going to be, and that was included, this loss, 31,000 was included in the 189,000. So we're going to sum this up. And that's going to give us our 220,000. Then we're going to be taking our rate that we came to up above, the estimated effective annual tax rate. And this should be a percent. What, I missed it here. 38%. This might be rounded, by the way, as well, just so is it even. That's rounded. So just be aware of the rounding. And then we have the first quarter tax provision for continuing operations. So that's going to be equal to the 220,000 times the rate. And that's going to be the 83,989. Notice when you multiply by something that is rounded, doesn't actually equal exactly the 38%. It's gonna in Excel, it'll use the exact number. So if you were to do that in a calculator and you didn't see the decimals, then it would come up to slightly something different. So just take that into consideration when you're thinking about these items. It is an estimate, of course, that we are putting together. So rounding shouldn't stop us either way, because obviously it's an estimate. Okay, so then we're going to say income tax expense. The journal entry that we're going to have then is going to be a debit to the income tax expense of the 83,989, and we'll have a credit to the income tax payable for the same amount.